Good morning, and thank you for the opportunity to share a little bit about the journey that we're on at IR. What I'm going to do over the next few minutes is I'll give you a little bit in terms of the background of IR for those that aren't familiar with the company. I'll touch on our FY19 performance for the fiscal year just completed June 30. And I'll also talk a little bit about where we see the growth opportunity for the company. As Chris said, day 53 on the job, so I'm ably assisted by Peter Adams, who is our CFO and also held the role of interim CEO prior to me joining. That's code for if the questions are very difficult, I will defer. What I'd like to in terms of day 53 on the job, what I like about what I've seen coming into the company, obviously as Chris has already profiled, I've spent a lot of my career in enterprise software, both on the infrastructure side as well as the application side. What I like about IR is in the time that I've spent, and I have busied myself with getting around the globe, in fact head off next week to our Singapore and European businesses, is spending time with customers and spending time with our teams. And what I like is there is validation that we have an absolute blue chip customer base. We have a compelling value proposition which in many cases can in fact be described by a customer back to you better than you can describe it to them, which is always a heartening sign in our industry. And we've got good growth prospects. We were founded a little over 30 years ago by a gentleman by the name of Steve Kilalea. And we today would boast that we are the #1 vendor in user experience and performance management for UC, or Unified Communications, payments and infrastructure. Infrastructure is where we started, in fact, on the back of the Tandem non-stops. 95% of our revenue comes from outside of Australia. And our core product line is, the brand name is Prognosis. And it's important to understand that that is a single line of code. So some 30 years ago, Steve had the foresight not to develop us as a product company, but to develop us as a platform company. And for those that follow the tech sector, you'll appreciate that if you look at the companies that have succeeded in our industry, they are largely, in modern terms, a platform type company. In fact, if you look at the top 10 largest companies in the world by market capitalization today, including brands like Apple, Amazon, etc., at a technology level, they are all platform-based companies. Our competitive advantage comes partly from our technology platform because it is extensible, and that's how we've been able to continue to innovate by moving from originally infrastructure, then into payments, and then into UC, leveraging the core services, if you will, that exist in the platform. It's a real-time platform, which is its key differentiator from a competitive standpoint. So business use cases that require real-time monitoring, assessment, and analysis are our sweet spot. And as I've already laboured the point, the platform play is extensible and scalable. We're a known and trusted brand, and in many cases we are deeply embedded inside some of the largest brands so that they may not know you up front, but deep in their core processes like payment transaction volumes, like their video and voice services, we are deeply embedded. And in fact, as a brag slide, greater than 25% of the Fortune 500, in fact, are Prognosis or IR customers. And in fact, I'll share a quick anecdote. When I was in the US recently, I visited with a company called WorldPay, who in fact on the day I visited with being merged in, I keep getting them mixed up whether it was FIS or Fiserv, but they now, as a combined entity, process greater than 1/3 of all credit card transactions in the US. And I landed in an airport in Cincinnati, which I later found out was actually not in Cincinnati, but it's in the back blocks of Kentucky. Drove for 45 minutes to a nondescript building and this happens to be their large operating centre for credit card processing in the US. And when you go into this building, it's like a theaterette style, their operating room, and the front screen, which they proudly tell you cost $1 million to put in, and it's like a scoreboard at a sporting facility. The entire screen is Prognosis. And what you're watching live real time is literally thousands of credit card transactions being processed a minute by brands like Macy's, Target, all these large retailers. Every one of those transactions being monitored by Prognosis. Interestingly, when I asked the CTO what they were doing before they used Prognosis, his response was, we waited for customers to call us to tell us that they couldn't process. And you can appreciate that if a retailer can't process, you have significant revenue leakage. That helps define at a simple level what we do in one of our verticals, being payments. So what is Prognosis? And I won't labour too much, but in terms of getting an understanding of what the product does, and I'll touch on largely building from the bottom up. Our core capabilities include things like root cause analysis, our ability to proactively manage performance in mission critical environments, the ability to reduce what we call MTTR, which is the mean time to resolution for critical issues in those environments, capacity planning and reporting. And one of the core things that it differentiates us is our ability to capture deep metrics. Chris referenced my background with Computer Associates, or CA Technologies of late. They were an enterprise management player, and if you think about them, they were this wide and that deep. They stitched an entire organisation together. IR and specifically Prognosis is the reverse. We're that wide and we're that deep. It means that we're incumbent and pervasive in the customers that we have. As referenced, we serve 3 domains. Infrastructure, which is essentially the Tandem non-stops, which became the HP non-stops, and pleasingly, as of late, it's reported that in fact server shipments are back up. So large enterprise customers are making choices that they won't move to cloud as rapidly as some would have thought. There'd been a slowdown on server purchases for the last 2 or 3 years, and now companies having made those strategic decisions are starting to bulk up in their own data centers, etc., which is a good sign for us. The 3 domains that we serve, including the infrastructure, payments, where we're doing monitoring of transactions, payment transactions, ATMs, fraud, etc. And then in UC, it's the whole suite, and that's where the term unified communications comes from. It includes the VoIP video, contact center, call recording assurance, etc., which is important to the financial services industry. And then on top of that, we have a professional services organisation which installs, configures and optimises our customers' environments. So let's switch gears now and touch on FY19 results. So there were strong results for the fiscal year just completed. For the first time, the company broke through the $100 million revenue barrier and the $20 million NPAT barrier. So our license fee revenue, which is a core to us as a software business, was up 19% on a year-over-year basis, and our basic EPS was up 14%. You can see that our trailing CAGR for the last 7+ years is at around 11%. I talked a little bit about the brag slide in terms of the customer base we hold, and you can see some of the world's largest brand names there. We're deep in the technology, IT and telephony sector or telecom sector. We're deep in the financial services sector. And then even in what we've loosely termed the other category, we have, again, some of the largest names that you would see in the corporate world there. We have increasing growth in some of those vectors, including you'll see some higher education logos there, increasing with some healthcare, etc. So we'll touch on growth in a little bit, but we believe that there's a continued opportunity for us to continue to expand within our customer base. Importantly, our products are very sticky. They are touching mission critical processes. They are well embedded, and that's borne out by the fact that our maintenance renewal rates are greater than 95%, and our recurring revenue base is up a percentage point this year, and I'll touch on that in detail in a bit, to 89%. So let's talk a little bit about the opportunity. I framed this up in the old Ansov matrix style in terms of looking at two vectors for growth. One is market acquisition, and the other is continuing to bring new products to market. I look at it in very simple terms, particularly having come from the sales commercial side of the house in terms of my corporate career. The good thing about this model is that there are multiple vectors for growth. So at an ambition level, clearly we want to double the business. And in fact, on the earnings roadshow, Chris asked me how long that would take. I quipped to him that we believed it would be shorter than it took us to get to the first 100, which was 30 years. We have an ambition, we have a plan, and it's not a single point plan. There are multiple vectors that we can leverage, and I'll talk to some of those now. In terms of what we need to do and do them really well is maintain the base. I've already laboured the point that we have this wonderfully rich customer base, some of the best logos in the world. 95% retention rate. Interestingly, of UC and payments, which are our two largest revenue contributors, the underlying growth metrics that support those businesses are both growing. So our licenses in most cases are monitored by two things, either end nodes or users in the UC world, and payment transaction volumes in the payments world. So there are thresholds in the customer contracts that we have. The market assessment is that payment transaction volumes through our strategic planning horizon, which takes us out to 2025, is growing at about 14%. And per Gartner, the UC growth is in the low single digits, so not quite as generous, but what I'm saying is point number one is the underlying metric that drives our commercial model is growing. Secondly, when we do a renewal or an agreement, and we've migrated most of our customer base to what we call term-based agreements, so there is a renewal event that comes up. When we do those renewals, we have the opportunity to extend the length of the agreement, increase the capacity of the agreement, as well as add in new product. And that's where we see this grow the base opportunity. By carefully managing and taking a disciplined approach to product lifecycle management, because of the rich customer base and the leverage that we have there, we believe that we can continue to add to what our customers are using from us today. And then we have a well-advanced next-generation platform work effort, which will do two things for us. It's a cloud-based platform, so it will take us into a modern, componentized, lean, agile platform for customers that will take some of their workload to the cloud. And because of the fact that most of our customer base is in the high-end enterprise, they have a more conservative view of migration to the cloud. So we will be able to offer them a mid-step between going from on-premise to cloud, which is the hybrid journey, which means you can take them on the journey with you, which means that you can leave architecturally some of the technology on-premise and then provide them with complementary, additional and expanded capability and functionality accessed through a cloud-based platform. That's what we call hybrid. Lastly, in what we shared during the earnings, we've done some work around what a pro forma subscription base would look like. So I've said over the years we've migrated from having a fair degree of perpetual licensing in our model to basically being predominantly term now. We believe that we will, over the strategic planning horizon, see a further growth and shift to subscription. We don't have a firm view as to what percent at this point in time, but we are flagging, and the reason that we shared that information was that for shareholders and investors in the company, they can get an early sense of what that would look like. So the operational summary from FY19, payments had a massive year, up 92%. Good execution and strong renewals in the portfolio. UC was down 7%. That was inconsistent execution, and we have a good outlook for FY20. Europe returned to growth with 19% growth. Good execution, particularly in terms of large deal closure. So the results summary, I won't go through it all in detail. I'll touch on 2 or 3 key things. Revenue was up 11%, and then on the first slide you saw there where the CAGR over the last 7+ years, so it's consistent with that. Excuse me. NPAT was up 14%, and our cash flow from operations was predominantly flat, but I will make the point that we reduced our debtor factoring in the year, so a very good sign in terms of the health of our cash flow. I'd make the point that we have high quality revenues. I've talked about term renewal. Those 3 charts or graphs on the top there would give you an indication of how that trends. In FY19, over 45% of our license fees were on 5-year term deals, so there's a good commitment from customers to the long-term use of our product. It's 89% recurring. So what does that mean? It's term recurring, meaning that there is a renewal event. But if you take the aspects of our revenue mix that are of a recurring nature, it is 89%, which is a very healthy percentage for us as a software vendor. Our customers, you can see a little bit of change in the shorter term deals there, in the 1 and 3 year deals, but on balance, there is still a very good and strong commitment from customers. And as you can see from the table below, these are large global brands. Give you a quick look at our geographic revenue. So the Americas has predominantly been flat for the last 2 or 3 years. We've made a change in leadership there and are very confident that we're back on the right track. Europe, as I've already discussed, they had a dip in FY18, FY19, we've seen a return to growth. Again, we've brought in strong new field leadership there and believe we will continue to execute well. And then Asia Pacific continues to have a very consistent growth story with good execution and strong leadership. Give you a similar view by product now across our 3 major product groups. So payments had a very good year. Again, in FY18, you can see that they were down a little. So the way that I would describe our position from a product standpoint is we expect growth in FY20, but not in the same range. UC being down, we expect that to return to growth in FY20, and we have a good renewals pipeline to support that statement. Infrastructure, it's somewhat cyclical. The longer term outlook for this part of our portfolio would be flat. All right, so let's talk about key drivers for FY20. I touched on the way that we simplistically think about growth inside the company, and that's maintain the base, grow the base, and then layer in new products. So how do we apply that in operational and practical terms in FY20? Our renewals base would give us reason to believe that there is a good opportunity to continue that recurring nature. And I'm going to just share with you an example of how a deal plays out. And inside the company, we have coined it the perfect deal. So we did a large deal in H1 of FY19 with Barclaycard in the UK. Barclays process about 60% of credit card transactions in the UK, and they have a very similar operating type centre as the one I've referenced, having visited with WorldPay. Barclays, without putting numbers around it, but if we took their classic renewal and said that we just flatlined that and renewed that, let's say it was $1, and so we just renewed it at $1. What we did in that deal is we essentially 3x'd the deal, because by committing to a longer term, 5 years in this case, the customer then baked into the agreement their projected capacity growth rates of payment transaction volumes. They added time to the deal, they added capacity to the deal, and then on a third vector, they added new product. So we've predominantly in payments been very strong in a payment switch environment, which is called Postillion and Base24. They have a significant part of their environment, which is an NCR platform. in return for us to committing to extending our product to help them manage that environment, the NCR environment, which is new product, they then committed to a 5-year strategic journey. So essentially we took $1 and multiplied it by 3 through a process of negotiating a deal. That's what we mean by the strong renewals base giving us this great platform for growth. With UC, as I said, a disappointing year in FY19. The reason we're confident in FY20 that we'll return to growth, new leadership, there's a strong renewals base that we can work from, and we've made some tweaks to our coverage model to ensure that we can execute better at a field level. We run our coverage model, our go-to-market, in both a direct and indirect sense. As a company, being a smaller company, we are targeted at the top end of the customer pyramid on a direct basis. In the UC space in particular, partners like Cisco, Avaya, and then some of the service providers like Dimension Data, Presidio, CDW, etc., they will bake us into a managed service. And in many cases, customers, or the part of the customer pyramid that is moving to the cloud is that mid-sector. So these partners give us reach into that sector without us having to build out an entire coverage model, go-to-market to do that. Additionally, they also have a resell. So they will, in many cases, resell our product into that sector, where their managed service or the service they're providing, they will tack on our product as an enabler for a company's unified communication environment. We had some execution issues there in the past. They were silly things like being too hard to work with, our pricing level was wrong, etc., etc. We've remedied those issues, and we expect that in FY20 we'll see growth in that sector. New customers. So one of the concerns that I had coming into the company was, having such a wonderful set of customers, such great brands, etc., are we tapped out? And my confidence now, after the short time I've been in the business, talking to customers, etc., last year we added 26 new logos. And when you think about being very heavily penetrated in the top of the financial services segment, and then you add 2 new customers who happen to be the 3rd largest bank in the world and the 9th largest bank in the world, that gives me a little heart flutter to say we ain't tapped out in any shape or form. We have a continued good growth opportunity to add new customers to our base, extend with our existing customers, etc. We've got tweaks in our coverage model. We've got new products that a small percentage of our customers have that we can add to the existing portfolio for customers. I'll summarise, I'll leave it on there and then I'll summarise. So the 3 points that I would make to you is that we have a very strong customer base with a well understood value proposition. Again, at the start I quipped to you that in many cases the customer can actually tell you in better terms than you can tell them what our value prop to them is and the value we provide. It's a trusted brand, it's embedded, it's pervasive, and we are now extending with cloud innovation. And thirdly, our growth plan is a multi-vector growth opportunity off a very strong base. It is not a single point sensitive growth plan. We have a number of vectors and levers that we can pull to continue to grow our business. With that, I will open it up for questions.